Hello guys, today I would like to discuss three different companies. The first company is Rost stores, the second one is Burlington stores, and the final is Dollar General Corporation. From Finance Yahoo, we can see that 5 years ago the share price was 88.87 and the current one is 139.71. From earnings per share, we can see that the company bet its second quarterly earnings, it bet its third quarterly earnings, and it bet its fourth quarterly earnings. Burlington stores 5 years ago was at 175.21 and its current share price is 223.17. It's bet its secondary quarterly earning, its third, and it bet its fourth quarterly earning. The Dollar General Corporation started 5 years ago at 171.81 and it fell to 93.56. And unfortunately, they failed to meet their secondary quarterly earnings, their third quarterly earnings, and their fourth quarterly earnings, which is concerning to us as shareholders. Let us now talk about their financial statement. The first financial statement I'd like to discuss comes from Rost stores. From their consolidated statement of earnings, we can see that their sales have improved over time from 18 to 21. However, their costs have also risen proportionally from 13 to 15. Please remember this is in thousands. And finally, their net earnings have gone up from 1,512,000 to 2,090,000, which is good news to us as shareholders. From the consolidated statement of cash flows, we can see that the company's net cash provided by operating activities was similar to their 2024 value. The same goes with the investing activities. We can also see an increase in financing activities from 1,428,000 to 1,858,000. This increase is mainly due to the company's payment of long-term debt, which is nothing to worry about. Their consolidated statement of cash flows is relatively stable. Moving on, let us now talk about their balance sheet. When it comes to the company's consolidated balance sheet, we can see that there hasn't been any major movements. The value of current assets is relatively the same as last year. The same goes with long-term assets. We can see that the company has decreased their long-term debt. And as I have mentioned before, they are repaying it, which is a good thing. And we can also see that their accounts payable rose from 1,955,000 to 2,126,000. This is again a good thing. Moving on, let us now talk about Burlington Stores' financial statement. Burlington Stores' total revenue rose from 8,702,000 to 10,634,000, which is a good thing on its own. However, although their net income did rise as well from 230,000 to 503,000, the proportion between their total revenue and net income is too small. They need to increase their revenue more or decrease their costs. A company which has such a high revenue shouldn't have such low net income. Let's now talk about their cash flows. From Burlington Store's cash flows, we can see that their operating activities haven't changed significantly. In 2024, it was 868,000, and in 2025, it's 863,000. Their investment activities went up from negative 503,000 to negative 882,000. The reason is because the company is investing in their future. They are purchasing long-term assets. Their property and equipment went from 492,000 to a negative 880,000. Their financing activities went from negative 318,000 to a positive 88,217. The reason why from financing activities changed so much is because the company is receiving their proceeds from long-term debt. The company also is purchasing treasury stock, which is a good thing. They are preparing for difficult times, I suppose. Moving on, let us now talk about their balance sheet. From the company's balance sheet, we can see that their total assets haven't changed significantly. Their property and equipment did increase, as I've mentioned before. It increased from 1,880,000 to 2,369,000. It's good that the company is investing in their future. We can see that their accounts payable rose, and we can also see that their long-term debt increased. I'd prefer it to decrease instead of increase, especially in the current time. As I've mentioned before, their treasury stock had also increased. In any case, that's all I have to say about Burlington Stores. Let us now talk about Dollar General Corporation. Dollar General Corporation net sales rose from 37 million, 20,612,000. Please remember this is in the thousands. It's good to see that their net sales rose. However, we can see from net income that their expenses rose even more than the net sales. Income was at 2,415,000 in 2023, and it fell to 1,125,000. I'd like to see an increase in income in the future and a decrease in expenses. Moving on, let us now talk about their cash flows. From the company's cash flows, we can see that their operating activities went from 2,391,000 to 2,996,000. The main reason why it increased is because the company is selling their inventory. In 2024, it was at negative 299,000, and now it's at 230,000. Their accounts payable also went up during this time. It went from 36,000 to 302,000. Unfortunately, the company's investments decreased during this time period. In 2024, the purchase of property and equipment was at 1,700,000, and now it's at 1,309,000. Hopefully, the company will manage and will be able to increase their influence in the future. Their financing activities went from negative 542,000 to negative 1,294,000. The main reason is because of their obligations to long-term debt. They are repaying it right now. The other thing I'd like to mention is their payments of cash dividends. The company is not in the best position right now, and I'd like to see a decrease in the payment of cash to shareholders. In any case, let us now talk about their balance sheet. From the company's balance sheet, we can see that there wasn't much movement in assets. We can see that their inventory decreased by a bit. In terms of liabilities, we can see that their accounts payable rose and that the company is paying off a substantial amount of long-term obligations. Long-term obligations fell from 6,231,000 to 5,719,000. In any case, that's all I have to say about their financial report. Let us now analyze all three companies using Finance Guru. I will be using Guru Finance in order to analyze the three companies I just talked about. Guru Finance is available on the App Store. All you have to do is put in the values to whatever company you are interested in, and the application will analyze your company. Let us compare the three stores. From Guru Finance, we can see that Rost stores has a better finance value, a growth, and better value than Burlington stores. And there are a few reasons to this. The first reason is that Rost stores has a better revenue and income ratio. About 9%, almost 10% of Rost stores' revenue goes into income. On the other hand, only 5% of Burlington stores' revenue ends up in income. The other positive is that Rost stores is purchasing a large quantity of their shares. That's why their financial activity is negative. On the other hand, Burlington stores is not purchasing their shares. Both companies have a large amount of inventory. This is nothing to be concerned about. Due to the nature of their business, it's expected for them to have a lot of inventory. And lastly, I'd like to mention the ratio between the company's total revenue and their equity. Rost stores has a better ratio in this case. Burlington stores doesn't. Let's now compare Burlington stores to Dollar General Corporation. From Guru Finance, we can see that Burlington stores and Dollar General Corporation have a similar finance condition. Burlington stores has better growth, but slightly worse value than the Dollar General Corporation. Both companies need to work on their revenue and income ratio and their revenue and equity ratio. That's all I have to say about the two companies. If we look at the market evaluation in 2025, we can see that Rost stores has a much larger percentage of the market compared to the other two. In 2024, Rost stores also had a much larger percentage of the market. Burlington stores in both cases had the smallest, and Dollar General Corporation was in the middle. In any case, let let us now put all three companies onto the review table. Now then, I'd like to say a few things first before I place them onto the rating table. Firstly, you have to remember that the three annual reports we went through were produced before the tariffs, so you won't see the effects of the tariffs on those reports and how the three companies are managing with those tariffs. The second thing I'd like to say is that these companies have a lot of competitors, a lot of big competitors, such as Woolworths, Target, and Costco. So you have to remember that they are not in an easy market. It's not easy for them to grow. And that's why, as shareholders, we have to be cautious. In any case, in my opinion, out of the three companies, Rost Stores is the best. It has the best ratios. They are purchasing their shares, which is always a good thing to see. Burlington Stores and Dollar General Corporation I would put in the careful section. The reason why is because I don't like the ratio between revenue and income, especially Dollar General Corporation. Their income almost halved during this 3-year period. I like to see an improvement in that. Burlington Stores is the smallest one out of the three, so it will have the hardest time competing against these big corporations that I mentioned. In any case, that's all I have to say. In the next video, I will be talking about banks. See you next time. Subscribe.